On December 26, 2025, as markets reopened after the Christmas holiday, the most important movement did not come from a policy announcement or an economic shock. It came from expectations. According to Reuters, U.S. equity markets resumed trading with major indices holding close to recent highs. Volumes were lighter than usual, but investor positioning reflected a familiar pattern. Markets continue to price in a softer interest rate outlook for 2026, despite the absence of any new guidance from the Federal Reserve. At the same time, Bloomberg reported on December 26 that interest rate expectations in the United States and Europe remain closely aligned. Investors are increasingly assuming that both the Federal Reserve and the European Central Bank will proceed cautiously, balancing slowing growth against the risk of reigniting inflation, rather than moving aggressively in either direction. This alignment matters across the Atlantic. When U.S. markets sustain elevated valuations based on expectations of easier financial conditions, global capital tends to follow that signal. European equities and credit markets often benefit indirectly as investors extend risk exposure beyond the United States, reinforcing a shared financial environment driven more by assumptions than by decisions. What stands out today is not action, but convergence. Markets on both sides of the Atlantic are behaving as if monetary policy paths will remain coordinated, even without formal coordination. That reduces volatility in the short term, but increases sensitivity in the medium term. Any divergence between Federal Reserve and ECB policy expectations could trigger rapid repricing in bonds, in currencies and equities. For households and businesses, the effects are gradual but tangible. Easier financial conditions support credit availability and asset prices, while at the same time raising the cost of entry into housing, equities and long-term investments. Nothing changed officially today. No central bank moved. No data surprised. Yet money adjusted. This is not about a rate cut. It is not about a single market move. It is about shared expectations, quietly shaping capital flows between Europe and the United States. When assumptions align, money moves calmly. When they break, it moves fast. This is not a warning, it is a signal.